One area of tax planning that is often overlooked is in retirement tax planning. And it's often overlooked because so many of us, and probably including yourself, might be thinking right now, I did all the right things while I was working when I was getting my paycheck. I set money into retirement accounts, and now I'd like to sit back and relax, right? And unfortunately, the IRS does not have an off switch. They just keep coming. And since you're drawing from accounts, unless you're specifically setting money aside for taxes, tax bills creep up on people real fast. So one of the things I wanted to discuss particularly in the point of today's video is on Roth IRA conversions and how it can help with tax planning for you and particularly your situation. So if you watched last week's video, it was on types of IRAs accounts. And if you did not watch that video, I highly suggest that you double back and watch it. But one of the key differences between a traditional account and a Roth IRA account is in how the money is taxed. So if you set up a traditional IRA account, as you're earning money and you set it aside, you're not paying any tax on it. You pay the tax when you withdraw the money from the account, which is great while you're earning, right? You're getting to set aside for your retirement and never have to pay any tax. But it bites you on the back end because, like I said, the IRS doesn't have an off switch. Whereas if you have a Roth IRA account, when you're putting money into that account, you're still paying tax on it then, which is a bummer. But then when you draw the money out and during your retirement years, you're not paying any tax on it then. So that's a big difference, and that's why I kind of recovered that today, is because it matters when you're doing the conversion, that difference. So when you do a Roth IRA conversion, what you're doing is you're taking your traditional IRA money and you're converting it to Roth money. And so when you do that, you're paying the tax on it when you convert it. I'll repeat that again. Even though you're not receiving any physical cash, when you convert from the one type of retirement account to the other, you're going to pay tax on the amount that you convert. That is significant because if you don't know and you just say, yeah, that sounds like a great idea, I'd like to convert my money to a Roth account, you're going to have a big tax bill potentially, depending on how much you convert, and you can get caught flat-footed. So keep that in mind, please, as you watch the rest of the video. And you may be saying to yourself, well, if I'm going to pay tax and I don't get any money, why in the world would I do that? And there's some key reasons why you may want to make that conversion before you actually draw money out of the account. So let's say you're in a sweet spot where you were able to retire, but you're not quite yet drawing Social Security money. And if that's the case, your income is probably the lowest that it's been in a long time, right, in terms of taxable income. And if that's the case, now is when you can fill up those lower tax brackets and convert money over, pay the tax on it then and now, so that when you're drawing Social Security and drawing from your Roth account, you're not creating additional taxable income. Why does that matter? Because how much other income you have on your tax return is going to drive how much your Social Security becomes taxable. So by drawing money out of a Roth account, you're not paying as much taxes if you would if you were drawing from a traditional IRA account. And another good reason to convert is because in a traditional IRA situation, you're going to have what's called that required minimum distribution, right? When you reach a certain age, you're required by law to take money out of your retirement account. And when you're retired to take money out of your traditional IRA account, same thing like we just discussed, right? You're going to be creating taxable income. You're going to have tax. That can make more of your Social Security taxable, which in turn can make your Medicare premiums go up, and you end up running into a real snowball effect on that front. So if you convert earlier on and you're drawing out of that Roth account, you're avoiding that required minimum distribution number as well. So these are just a couple of the key reasons to convert. And also, one of the things that I really like about the conversion process is you're deciding when you're going to pay tax, right? Because if you deferred it when you were working for somebody and getting that W-2 wage, You weren't paying tax then. And now you're in a situation where you can decide when you're going to give the government those tax dollars. Because when you convert is when you pay the tax. So let's say you're having a year with a lower income number, like we had discussed, potentially you just retired, or if you're self-employed and things didn't quite go the way you had hoped that year, you can fill up those lower brackets, and then you're choosing to pay the tax when you're in a lower bracket as opposed to potentially down the line when you might be in a slightly higher one again, depending on your tax situation. But that's just kind of a general overview on the subject. If you have any questions, please contact your tax professional. And I highly suggest that you contact them before you forego venturing into doing a conversion, right? Because you're going to want them in on the entire process. And if you don't have a tax professional, please give me a call here at the office. I'm at Advantage Tax and Accounting in Newburgh, Indiana. Our phone number here is 812-490-9600, because together we have the advantage.